Well, hello and good evening. It's Martin North here from Digital Finance Analytics. Welcome to our live stream event on the 7th of April 2020. Glad you could join us, and I think we're going to have a really interesting conversation this evening. As normal, the first part of the show will be me just going through some of the basic material that is fresh off the press, as it were, and then I'll come to the questions and answers. I've already got a lot of questions that people have sent in beforehand, but I'll prioritise those on the chat first. But if you have specific questions that you want to ask, hold off from asking them now, because I'm not going to be looking at the chat stream for a little while. So without further ado, let's just get this show on the road. And just to start off, it's worth saying, I think, that the normal running order, which is what we do first, will be the introduction, very quick. House rules, very important. About our models, again, it's just important that people understand how we get to the information that we get to. Some key slides. Those key slides will be really, really important today with everything that's going on. And then we'll actually go back to some questions and answers. And the bulk of the show will be questions and answers, of course. Typically, these go for about an hour and a half, plus or minus. Might run on a bit if there are lots of questions, but I ran out of smoke after about an hour and a half, so probably around that. Now, in terms of house rules, I just want to say this is not financial advice. I can't give you financial advice. I'm not qualified to. It's my own opinion. It's my own research. If you need specific advice, go find a financial advisor. You won't find one here. Please play nice in the chat room. The chat is being moderated, and I appreciate the help from the moderators. No racial slurs, please. There are lots of good conversations that go on through the chat, through the show, and I just don't want to have stuff going on that we don't need. So there will be some moderation if required. This is as at today, the 7th of April 2020. Who knows where we're going to be in a month's time or even a year's time, but I guess we'll come back and see later on. If you want to get my attention, please use that Walk the World. There are so many things going on the stream that really, if you don't use Walk the World, I may not see it. Nico, thank you very much. I appreciate that. I have enabled Super Chat. People have already been using it this evening. This is really, really helpful. One, you can make sure that your question has full visibility for a long time, so it's more chance of getting answered. And secondly, it's a way of you're helping to be able to fund what we do here. We don't make any money, profit from the DFA work here. In fact, a lot of it is funded from our other work. So when we get help from Super Chat and other support, it just helps to defray some of the expenses of running this stuff. And as you know, at the moment, we've been very, very busy with daily updates because there's just so much going on. So your support is absolutely critical, and it's really appreciated. So just quickly, the DFA core market model, I've gone through this a few times, but just so you know, we survey households. Very important now because there's so much change in the data. We survey businesses, small businesses, put all of that plus a lot of other information into our core market model. And the core market model then essentially drives everything through to the analysis that we present on the website, through to customer client work as well, and other things. We can slice and dice the model lots of different ways, by location, by customer segment, and a lot of other things. And quite a lot of information means that we have a unique perspective, but this perspective is driven very much from the point of view of households and businesses. So we're looking at it from a business in and a household in rather than a banking product. Now, one example is the Household Financial Confidence Index. It crashed in March down to 73.2. This is effectively a top-level summary based on asking people about whether they're more or less confident about their jobs, their incomes, their expenditure, their debt, their savings, and their net worth. And this has never been so low. Remembering that 100 is neutral, so this is in deep negative territory. And interestingly, it's true not just for those with mortgages or those renting, but with everything that's happened with the markets and more broadly with the health-related issues, those with property but no mortgage and those with stocks and shares and no mortgage, the free affluent as I call them, have actually taken the biggest hit in the last month. And That is pretty dramatic, and it says that we have significant issues now with households and their ability to be able to deal with everything that's going on at the moment. And not only we say that, but ANZ-Roy Morgan also said it. So they published their consumer confidence data, which dropped like a stone last time. Thank you very much from Eccles-Lurk. I think that's right. Really appreciate your contribution there. So the ANZ-Roy Morgan consumer confidence bounced a little, but it's still in deeply negative territory and is still way down from where it was. True also with business confidence as well. The Roy Morgan business confidence research came out today, down another 9.1%. That's a new record low, and actually more than 4 points below the previous bottom of 99.8 back in July 2011. Now, they also made the point that it was better the first 2 weeks. It was the second 2 weeks. That's basically where all of the tightening of controls came through, and though that's one of the reasons why the index is really low. So expect a lower rate later. And the ABS came out today and said that 66% of Australian businesses said their turnover or cash flows had been reduced, and 47% of businesses made changes to their workforce, and 38% have changed how they deliver their products. Is quite an amazing situation, and it's just part of the story of what's going on with business. Business is really very difficult at the moment, and of course it's not uniform across all businesses. Retail, the entertainment sector, the accommodation sector, the tourism sector, all of those are being hit, but more broadly as well now. Now, if I go on to talk about mortgage stress, so this is one of the really important pieces of analysis we do. We analyse mortgage stress. We define mortgage stress not as a standard 30% of income, but essentially looking at it in terms of cash flow, money in, money out. So essentially we say if households have less money coming in, then they need to be able to make the various repayments going out. Even taking account, for example, that they may have mortgage repayment holidays, then they're in stress. And there's also a lag between stress and default. So, for example, in WA, we saw significant spikes in stress over 2013 to 19, and now we're seeing high levels of default. So stress is a leading indicator of trouble ahead. And by the way, we also look at financial stress and rental stress as well, but this is focusing on mortgage stress. And this is what we published a few days ago, that the mortgage stress rating in February was 32.9% of households. It's now up to 37.2% of households. In other words, there's an extra 200,000 households now in mortgage stress. They're having difficulty making those mortgage repayments. And on that modelling, we're projecting forward that it could be as high as 41.7% by August. And that's taking account of those who have been able to make some accommodation with their lenders with regard to interest repayment holidays, or indeed total repayment holidays. So that's a big deal. And we can actually analyse it by different types of households. So young growing families, 72.2% of young growing families are exposed, and that includes many recent first-time buyers. AK47, thank you, appreciate it. Defaults actually still are quite low, and that's thanks to the employment rate, which probably got about 10%, but it was expected to go up to 17% before the government intervention with JobKeepers. But the fact is that the mortgage stress does give us some forward indications. It's also worth saying that other segments are also impacted. So pretty much wherever you look, you can see some difficulty. Across the states, Tasmania has the highest percentage distribution of those in mortgage stress. That's a combination of very significant home prices, large mortgages, and flat incomes. But of course, Victoria and then New South Wales have the largest counts. And you can look at it across the major centres. So of course, Melbourne, Sydney, Queensland, Brisbane and Moreton Bay, Adelaide are all up there. But you can also see some of the regional centres are also being hit too. So pretty much mortgage stress is not just a headline in one or two places. It's pretty widespread. And the percentage varies, of course. You can see there the dotted line between 60% at the peak and 20 or 30% in different locations. And then you can also go further and look at individual postcodes. So this is now down to the postcode level. And Fountain Gate and Narre Warren in Victoria, that's 3805, has the largest number of households in mortgage stress. Followed then by Ballarat, and then Sydenham, another Victorian postcode. And I just want to highlight the two there with the little arrows. So just take account there of Hooper's Crossing. Is it Hoppers? Hoppers Crossing, sorry, I always get that wrong. 3029, and also Cranbourne, 3977. Just file those two postcodes away because I'll be bringing them back in a couple of slides. Now we can also model this in terms of geomapping, and this begins to show that I've just taken Melbourne as an example. This shows you that there are very significant pockets where stress is high. So you can see there the darker colours are high levels of stress. So if that's the centre of Melbourne, you've got down towards Dandenong, down that sort of area. Those are modern corridors, often on new estates, relatively small plots, maybe limited infrastructure. But interestingly, quite a few of those locations have above average incomes and home prices. And I'll talk a bit more about where I think home prices are going shortly. Now, the other thing I want to bring in now is forced sale. So we've done some modelling specifically on looking at those people who are being forced to sell. And around 2% of owner-occupied properties are now being subject to forced sales, but 8% of investment properties, according to my estimation. And it's distributed quite interestingly across different segments. So what we're finding is that for the investment group, actually older households, stressed seniors and wealthy seniors are the ones who are now being caught. Many of those are actually investment properties, and it's simply that those investment properties are not performing, and so they're looking to get out and try and release equity. Whereas on the owner-occupied side, it's a rather different set of households, particularly some of the younger, the suburban mainstream groups as well, so the higher percentage, the bigger the distribution. And the other point to make there is SQM published this today, that the number of properties being listed has gone up. So if you look at the monthly change, between February and March in Sydney, it's gone up 10.5%, in Melbourne up 5.7%, in Canberra up 11%, and in Darwin up 15%, and nationally up 3.7%. So we're starting to see relatively more listings than a couple of months ago, but still well down, 30% down from last year. So that's a big deal in terms of what is happening. Truth Seeker, thank you very much. I appreciate it. And now this is where I want just to come back to that map. So this is again Melbourne, and what I've done now is I've looked at forced sales by postcode. And those two postcodes that I mentioned earlier on are the two that are actually showing the highest levels of forced sales. So essentially, if you've got that sort of reddy colour or even some of the yellowy colours, those are higher relative to the blue colours. And that shows you that there is an interesting correlation now between mortgage stress and people trying to get out. And essentially, the survey shows that households are actually trying to get out to release capital. They're trying to get out because they're having difficulty with those mortgages. And a few now are under pressure from banks to try and get out. At the moment, forced sales by banks are very low. The main reason that people want to get out is property investments that are actually no longer working. They're just not able to make the income work anymore, and so therefore they're now trying to sell and get out quickly. The question, of course, is will they have missed the boat? Probably, but we'll see, hey? Then just a couple other quick things. You might have seen that around 360,000 households want to draw down on their superannuation. The government's basically said you can draw down 10k and then maybe another 10k starting mid-April. But Host Plus, for example, has rewritten their PDS, product disclosure statement, to make it more difficult to switch or even pull. Now, they claim that this was done before the changes that the government brought in or because of the health issues. But the timing is really interesting, bearing in mind that Host Plus was actually, of course, servicing a lot of people in the the tourism and entertainment sectors, those sorts of things. And also the fact that they did announce revaluations on the downside for some of their unlisted real estate trusts and those sorts of things, and some of their other investments. So it could well be that this is part of the pressure on superannuation funds. And as more people try to withdraw at a time when the markets are down, we're going to see a lot of pressure, I think, on superannuation. And many people are seeing their superannuation balances dropping quite significantly. And also what it means is that those who are staying in this fund could well could well end up taking the biggest hit later. Now, the RBA today said that there was just a little bit of market improvement. They're talking about the financial markets. They said the rate will stay low for a very long time. They've said that there will be a very significant hike in unemployment and that growth will crash, but they haven't really given us any figures. Maybe it's too soon. I think it's probably true to say that we are going to see very low rates for a very long length of time. They talked about more market intervention, buying more bonds. They've already bought quite a few and will continue to do so. So we need to continue to watch that. And of course, they're also flowing very cheap funds back to the banks to help them to lend. As I did highlight in one of my earlier posts, what we're actually saying to people is, if you're in difficulty, borrow some more money, feel free. The trouble is you still have to pay it back, and that is a big deal, I think. Now, the authorised deposit-taking institutions and insurers have been sent a letter by APRA. And basically, APRA today warned that banks should be, and other FIs should be very careful about dividend distribution, and they should be initiating prudent capital management actions. Now, this is quite interesting because in the UK and in some other countries, banks have been told and FIs have been told not to pay any dividends at all. APRA has been a bit weaker than that. They've basically said, if you can prove that it's okay to make dividend payments, then make some, even if it's a bit lower. Otherwise, be careful. This is a really very important point. I think, again, APRA is proving to be very weak relative to the regulators in other places around the world. My view is that given the current situation with the banks, given the fact they're going to have high levels of losses, given the fact that they're being given very cheap money from the government and from the central bank to be able to keep lending, it seems to me that shareholders should be the ones to take some of the pain as well. It would be disgraceful if we ended up with banks paying the same sort of dividends that they paid previously in this crisis, bearing in mind that the banks have been effectively bailed out indirectly by the government. And I'll come back to that as we go a bit further down the track. Also, just in the US, there was a pretty astonishing post from Liberty Street Economics. This is the Federal Reserve of New York. They actually published a paper arguing that in a time of crisis, bank-specific information should be withheld because it helps to ensure that there's no bank run. And they quoted information from the 1930s and showed in their paper that by not disclosing information about specific banks, then that kept money in the system. Now, they're not talking so much about deposits for all ordinary households because there is a deposit guarantee scheme in the US. They're talking more about larger deposits from corporations and other entities who've held the money with banks, large amounts of money, and they're worried that effectively if it comes out that the bank's balance sheet is not as strong as people thought, they might whip that out and then create a run on the bank. So it's pretty astonishing, bearing in mind all of the disciplines that were put in place over the last 15 years or so, and particularly after the global financial crisis, to have more specific disclosure. And in the US, there is very strong disclosure about individual banks' balance sheets. Not in Australia, I should say. We only get very generic information here in Australia. But it's pretty astonishing that they're now saying, well, maybe we should actually dial back that disclosure to protect the banking system. And just in terms of just how wicked a problem the health issue is, the BIS Bulletin today said, given the historical perspective of economic activity, the reduction of GDP due to the confinement measures are likely to drag on over several quarters. So this is not a short, sharp V-shaped recovery. Total GDP shortfall could be as much as twice of that implied by the direct initial effects of confinement. This persistence reflects in part two types of spillovers across country. One is due to the risk that uncoordinated confinements lead to repeated virus outbreaks and confinements across the globe. Another is the more traditional trade and financial integration interlinkages. And the economic spillovers and spillbacks across the major economic blocks are large. There is no immunity from the economic effects if the epidemic is controlled in only one or two regions. Countries should adopt confinement, border control, and macroeconomic policies that internalise these global consideration. So the point is, you can't just fix Australia here. You actually have to be able to fix this on a global basis, and you have to be able to execute the confinement strategies for as long as it takes to do that. That's why all those people who are saying, oh, this is just a month or two before things get back to normal, I think are missing the point. And, when the BIS comes out, BIS, of course, the central banker's banker, I think that's pretty significant. Now, let me touch on the scenario. So we run the scenarios on a regular basis, as you will know from all of our work. This is an assessment of trying to see how things develop. And those scenarios give us an indication. They won't be 100% right, but nevertheless, it gives us a bit of a view. And here is the latest set of scenarios updated today. And basically, there's a 0% of a little local difficulty, which is what the RBA originally was talking about. There is a 5% chance of what I call a short-term wonder. In other words, it'll be fixed in a couple of months or so. Even then, I was expecting home prices to fall. There's a 20% probability that we're going to have a longer-term crunch, and unemployment rate maybe up to 9%, 8.75%, mortgage stress up to 40%, bank losses rising to 19%, and prices somewhere between 20 and 30% down from recent peaks. I give that a 20% probability, but the 60% probability is what I call global disruption. So this is effectively just what the BIS was talking about, the fact this all spills over into other economies. And as a result of that, I expect the Reserve Bank rate to be very, very low. It might even get to zero, despite what they say. The unemployment rate is a modified 10%. That's because the government interventions have basically taken people off the unemployment list and connected them back to their companies. But nevertheless, it's still double where it was previously. Mortgage stress 40 to 45%, bank losses at least 30 basis points or higher. And that's taking account of all the deferrals, the fact that APRA has allowed the banks not to declare deferred loan repayments delinquencies. But I'm thinking that home prices are 30% or 45% down. Interestingly, Domain came out today and said 30% is actually now a realistic midpoint in terms of where home prices could fall to. There will be some bailouts. We've already started to see the bailouts. Money going from the central bank, money going from the government into the banking system to support it. The banks are in Australia basically supported by the government. They're on the same side of the fence. There were some bail-ins, but the bail-in so far with NAB was a planned bail-in of hybrid securities, which is fine. There are some more hybrid securities to come. Whether we go beyond that, who knows? My own view is that given the amount of money that the central banks are prepared to throw at the problem, I suspect not, but we'll see. That's got a 60% probability. And then there's this thing called the uncontrolled pandemic. So basically, if you don't do the isolation, if you don't do the other stuff, then my view is that you have even a longer and more severe issue. But I think that's unlikely. So my central scenario is a global disruption with home prices down 30 to 45% from their current levels over the next couple of years or so. And we should not be thinking that this is something that's going to adjust itself in a couple of months. This is going to be a long, slow haul, unfortunately. And I have to tell you that this is not good news. It's not what a lot of people want to hear. And a lot of people are saying, well, just trade off more deaths for better economic outcome. My own view is that's quite complicated to do, and lots of risks attached to it. Okay, so with that, let me just come back to the main camera and let's see how we go. So let me just go back and have a little look at some of the conversations here. I can tell you the exact forecast unemployment from Treasury. I know 2 data points off the top of my head. Oh, really? Okay, Ian. Well, share if you do. So the point there is that at the end of the day, we are in a quite complex and difficult situation. I'm pleased to say that some people actually took the right decisions earlier on, paid down debt. They're in a good position. But I am worried about people who are being persuaded eventually to get into more debt to essentially try and deal with it. Now, Ashanti said, individual households are in tatters. I'm in data collection and it's heartbreaking. Yes, I agree. What's amazing as actually how quickly this has gone wrong. Now, of course, it's not surprising because we had a very significant amount of debt. The debt in the system is dramatic. We've got some of the highest debt to income ratios in the world. The 180, 190 debt to income. The debt to GDP is very high. The banking system here has been massively skewed towards property investing and owner-occupied property investing, owner-occupied property holders. As a result of that, the banks have massive portfolios of mortgages. Our property is at least 40% over neutral values, in my view, based on all the modelling that I've done. And so it's not surprising that households are now struggling. Of course, nobody assumed that incomes would suddenly dry up as quickly as they have. Everybody assumed magically that they will be able to continue to make those repayments. And whilst households to some extent are getting some relief because of the the government interventions and because of what the banks have been doing, the fact of the matter is that many households are already up against it. And that's why my prediction in terms of levels of forced sales is actually quite a bit higher than it was even 3 months ago. What else have we got? Okay, so Cookie Boy said, which of the big four and smaller banks which have the writing on the wall according to their books? Well, it's quite interesting because, of course, some have got a higher proportion of investment properties than other. We know, for example, that Westpac has had some of the biggest portfolios of investment properties over recent times. We also know that mortgage for investment purposes has grown very strongly out of Macquarie. So you'd have to hypothesize that some of those would have probably some more significant pressures than the meat and potato owner-occupied loans. The trouble is, of course, that if households essentially postpone their mortgage repayments, let's say for 6 months or so, what happens then? What happens if this health crisis is still going on then? What happens if we're still socially isolating and if businesses have folded or are just not firing? The chances are that you'd have to extend those repayment holidays for longer. And of course, people are just capitalising the interest and capitalising the foregone repayments. So effectively nothing is being given away. And the other point I want to make here is that the way that the government has structured all the support, it's flowing through to households via businesses. And that is quite an inefficient way, in my view, of dealing with it. My own view would be they should have gone UBI, Universal Basic Income, and pushed money directly at households. It would have been cheaper, it would have been more effective, and it would have been quicker. Because the other point to make is that some of the mechanisms that are being spoken about have not yet started to pay anything out. So households are already running out of cash flow. And around 25% of households, based on our surveys and other analysis, has less than 1 month's cash in the bank. So already some people are going to be struggling. This is a big deal. And I'm afraid that those banks that geared up, those banks that did interest-only loans, those banks that actually were on the interest-only side and the investor side of the house will be the ones struggling compared with others. But as I said, at the moment, all of the information that I'm getting suggests that the banks are being supported left, right and centre because central banks around the world are banking on financial stability. In other words, throwing more money, more liquidity, frankly, printing more money and throwing it direct to the banking system to keep the banking system strong. The question is, what's that doing to the real economy? Well, we might come back to that in another discussion shortly. Okay, let's have a look and see what else is there. So Truth Seeker says, how can I get help from the government to start a new business? No, it's basically you have to have been trading for a certain period of time. It's also true to say that most banks are not interested in lending for new business. They weren't previously, but even more so now. One of the big issues we've got in Australia is very little funding available to help new businesses start up. I've been beating on about this for a long time, saying the way that the mortgage lending system works in Australia is you're lending for property and you're lending for property investment. You're not lending to assist new businesses to start up. That has to change. We have to change the BAL ratings and the risk ratings. We have to encourage banks to lend to productive businesses. Now, one way to do that is to create a public bank and make that public bank essentially a vehicle that specifically lends for productive business purposes. Without that, I'm not sure we're going to get the amount of momentum that we need, but at the moment there is no intent from the government or from the Reserve Bank to aid new business startups, I fear. Right. So MP says, should we jump ship, and is the UK a good option? I'm not sure that the UK is a lot better, bearing in mind that they've actually managed the health crisis probably worse than we have here. They have more issues with regard to their health system at the moment, but they have bailed out existing businesses and existing households, in theory, more directly, about 15% of GDP, although I also understand that there are massive issues there in terms of execution. And this is one of the problems I keep coming back to. All of these highfalutin ideas about helping people, unless you actually execute well, it's relatively meaningless. And unfortunately, quite often what you find is pro-formerism. To quote one of my guests who actually spoke about this, where you tick the boxes and it looks all fine, but when you actually look at how it's executed, it doesn't work. So I'm not sure the UK is a particularly good option. I come from the UK, I love the UK, but I think they've probably got the issues. And by the way, their climate is not as good as ours. Okay, now this is one saying, what is a safe home for deposits in the long run? What is a safe home deposit in the long run? A safe home deposit. Now, I'm not sure what you mean there, Cluzak. Are you talking about what is the right amount to put to buying a property? Or are you talking about the right place to put money on deposit? You might want to just clarify your question, and I'll try and answer which way you want to go. Okay, the next one says, your figures based on real or nominal falls? In other words, 30 to 45%. I've included inflation in there, but inflation will be so low over the next few years. My view is we're probably going to get deflation, not inflation. So it's not going to make a huge difference. And have I spoken to John about the scenarios and his scenarios? Yeah, we're going to come back to that because, of course, he has some hyperinflation scenarios and some deflationary scenarios, none of which are very good, and we'll watch that as we go. Golden says, I think Martin is best Australian analyst, thank you, but the parasites have declared war on the people. Yeah, it is pretty amazing if you think about what's happened with the amount of money that's being thrown at the system. But like I say, think about where the money is sticking. It's sticking in the banking system. It's sticking in the business sector. And a lot of big businesses are grizzling about the fact that suddenly they're having to take risks they weren't expecting to. My view is this. If you are actually a business, and particularly if your business is running an investment firm, for example, or an investment fund, you should have been assuming these sorts of scenarios within your portfolio range, rather than just saying, oh no, everything's fine, we'll just go into unlisted funds and other things and then effectively ask for a bailout. It is I'm amazed around the world the number of large corporations who are just going direct to central banks and to government saying, bail us out, bail us out, bail us out. And it's like the old adage, and I keep saying it, you privatize the profits in the good times. So when they pay dividends, very high dividends, often because of share buybacks to their investors. But when things go wrong, then you are asked to take the public side, and basically you put public ownership on all of the losses. So it is not fair, it is not right, and yet that is precisely the way that the system is currently working. Okay. So Ian says 1.4 million by May and 1.7 million by June. I wouldn't have signed off from the forecast, but that was what was used for the stimulus. Yeah, interesting. The unemployment numbers are absolutely, my numbers would be not a million miles off those. Depends a little bit on also how you define unemployment. So what about those who are on the government scheme, that are still attached to their firms? Are they actually employed or are they not employed? I think the underemployment number will be the really interesting one, assuming that that's reported accurately. I think the underemployment number will be very big. I think the unemployment number will sit around 10% simply because of the way that the government's chosen to do it. It's a bit like APRA changing the way that they define loans in default to keep the number down, right? So basically, things have been done before, to change some of the definitional things to keep the numbers lower, so that some people complain that things are better than they perhaps are. Okay, and Mark says, if all those countries are borrowing to prop up their economies, do you think central banks will eventually just decide to write off all the debts? No, I don't think so. The model goes like this. Japan is probably the best example. So Japan has been at this longer. So Japanese central bank bought government bonds. They bought corporate bonds. They've taken ownership of share markets and other asset classes too. So more and more of the assets are actually owned by the central bank. They've inflated their balance sheet, and of course, because it's essentially a government institution, it means that essentially you lift both sides of the balance sheet so everything's fine. The question becomes, do you ever pay it back? And that's the really interesting question, because there is an argument to say governments can go on doing that forever because they're not like a household budget. You can basically just keep the central bank printing more and more and more and just inflating. You can inflate asset prices to an extent. That's part of the story. You'll inflate stock prices, but essentially you don't have to pay it back. As soon as you start going in the other direction and saying, right, now I have to start repaying this debt, that's when the problems start. Because then the question is, well, how do you do it? Because you do not have necessarily enough economic momentum to be able to actually create the economic outcome to pay it back. Now, the theory of MMT initially was that you would actually create the capacity to put a lot more money into the economy for productive purposes. So everyone would get a job so they could be productive, for example. You could invest in multiple things. But if all you're doing is propping up the financial system, then essentially you've lost the critical linkage that MMT is trying to make between investment and economic outcome, because you're creating a bigger pie that then you can share more of and effectively, ultimately, keep the debt under control. Without it, the risk is the debt is not under control. And I fear that's probably where we are. Now, then the question is, do you play this out and say, we get to the point eventually when the whole thing is unsustainable? Now, if the argument were one country only was doing this, then there'll be a run on their currency. And at some point, the currency would then be a bit, Zimbabwe-like, But if everybody's doing it, if all central banks in major economies around the world are doing the same thing, then the currencies are going to actually just march together. And so actually, you may not get a run on currency, which is one of the reasons why I'm becoming more and more convinced we won't see a lot of inflation. What we will see is stagflation. And recessionary stagflation at that. So effectively, all of this stimulus that's supporting the financial system may not be translated through to real economic activity in the real economy. And if that's the case, then we've just got not an issue that's 6 months or even 2 years. This is a multi-year problem. And at the moment, I see no policies actually being articulated by anybody in power to think about some of these things. Now, there are things that could be done. A bank that's there to lend to productive businesses, a focus on the reconstruction of manufacturing locally, the idea that we want to actually invest in real things that create real value rather than just financial assets. At some point, we've got to come to the hard decision about whether, in fact, there is a need to look really hard at the amount of debt in the system and the value of the assets in the system. And there are plans that potentially could look for a reset of that. Tough to do, but that might be something down the track, but nobody wants to talk about that at the moment. Now, Binary Agenda said the decision on whether to buy stocks now is the flip side of whether to keep stocks now. What would you say to people who already hold a lot of stocks and have been taking a bath recently? Yeah, good question. Look, I interviewed Harry Dent again today. He shows up on the DFA channels at the moment. And what Harry said was, we had a fall. Prices are going up a little. He thinks prices may go up a little more. And that is the time then to sell before the next big dive down. Now, he might be right, he might be wrong. Generally, when the prices are moving around in a bear market like they are, there is very little correlation between fundamental value and where prices go. And if you think that stock prices generally are correlated with future cash flows based on the earnings of a particular company, I don't know how you can assess the value of any company anywhere on the planet at the moment, because nobody knows what the economic activity will be, what the revenue will be, and therefore it's hard to put any valuation on any stock. And that means that whether you buy or whether you sell, you're taking a punt. And you might be right, you might be wrong. Harry's general view on this was, you might look to bail out if you see prices rising a bit, but otherwise just hold it through the cycle, because essentially, if you try and pick in and pick out, then the chances are you're going to get it quite wrong. There are many people, though, now who've called the bottom and basically saying that because of the fact that the health issues in New York in particular have slowed the growth, that means that the markets are effectively have gone past the bottom and now on the upside. It's too soon to know. I think we may know in a month or so's time. And remember, you don't crystallize losses until you sell. And that's worth thinking about, right? So, prices go up, prices go down. I've gone through 4 corrections over the years. I've tended to hold through those corrections and, for the rest of the time, have done reasonably well. I did bail into cash, though, some time ago because I could see the big one was coming. Didn't know what was going to trigger it, but something was going to trigger it. So I'm in cash at the moment and I'm comfortable with that position. I wouldn't go back into the stock market at the moment. Okay, now Deep Pan says, where do you see unemployment peaking? How would you compare this with the Great Depression? It'll be worse than the Great Depression, I think, because of the fact that whilst we're getting some government support, if you look at the true unemployment number, this is a global shock, a global problem, and it's not going to get fixed anytime soon. If you believe my scenario, which says this is going to go on for a long time, what the BIS said, right, this is going to go on for a long, long time, we may be able to clamp down on the health issue initially, but if we then start opening up the taps a little, the chances are that infection could start up again, which means you then got to close it down again. And even if you stamp it out in one geography, as soon as you start opening up the borders and start trade flowing or people flowing, you risk bringing it back in again. So the only sure way to deal with this, in my view, is to wait for the vaccine. Now, that's not a popular thing. There are a lot of people saying, no, you don't want to do that. It's interesting that the New South Wales Premier today in her press conference said we should be thinking about doing this for as long as it takes until the vaccine arrives, which I thought was quite interesting because there are basically 3 scenarios. Scenario 1 is you clamp down hard and what you try and do is to stamp it out completely, right? Scenario 2 is you keep some economic activity and you accept some level of infection, but what you try to do is to keep it within the health system. Or the third is you just let it rip, and if you let it rip, the modelling suggests that it's a really bad outcome. So somewhere between option 1 and option 2 is probably the way to go, but in both cases, the ultimate solution is a medical one, and you can't solve this through effectively economics. Now, CD1 or CDL says, how will the property market play out in Melbourne, Sydney in the next 3 months? Floods of properties for sale or hold out longer due to government and bank support? Do you see Fongo? Yeah, well, Fongo's already there. So I said to you about 8% of property investors are now looking to sell actively, and they are now worried. 3 reasons. Reason 1, rentals are now falling through the floor. A lot of those were actually using Airbnb, and so we're actually getting quite high rentals. That's stopped now completely. They're not getting anybody to come in, even if they discount the rents by 30 or 40%. So rentals are now very much a problem in terms of cash flow. Secondly, whilst they may be able to deal with their mortgages, many banks are being less generous with mortgage repayments for investment properties relative to unoccupied properties. So I've had quite a few people send me notes saying they applied to their bank for an investment property waiver for repayments and were turned down. So some people are finding it quite a lot more difficult. And thirdly, with the capital losses that we're now expecting to see somewhere between 30 and 40%, the value of that property is going down. It's going down every day, every week. And that means that people want to try and crystallize the value they can as quickly as they can. So there's a very significant rush to the exits on the investment side. On the unoccupied, not so much, because there more banks are actually being more generous, although the process of applying for a loan repayment holiday is quite cumbersome in some cases, and it takes a bit of time to get bedded in. But nevertheless, it looks as though the banks are actually more receptive there. And so that then comes to the small number of cases where effectively either the household has decided they need to get out, or indeed the bank is pushing them to get out. So that's how I see it. But I don't think we're going to see any price growth in the two major urban centres of Sydney and Melbourne. I think houses will hold their value a little more than units. Units were already under significant pressure. I also think the top end of the market for houses will also fall, because that bubbled up very significantly over the last 18 months or so, particularly over the last 6 months. And we would expect to see some correction there in the short term. So very little good news, I'm afraid, on property values. And just come back to my fundamental point, property values are 40% overvalued relative to their long-term neutral position. So we are in bubble territory, and that has to be taken into account. Now, Garth said, will a gold standard return? I don't think so. If we get them shift away from the US dollar, which is the reserve currency of choice at the moment. And of course, the Fed has done everything they possibly can to keep that going. Through the swap lines, they've extended swap lines to other central banks so that there are flowing quantums of US dollars wherever you need it. They are really working to keep the US dollar the reserve currency. The question is, how long will it be? And what might replace it? And I've discussed this previously. There are people like Mark Carney, Bank of England, saying, well, actually, it's probably going to be a digital currency, a central bank digital currency of some sort to replace it. Other people are saying it could be the Chinese yuan. Not sure about that. Some people are saying, well, all that gold that's been bought by Russia and China, does that then suggest it could be a gold standard? Don't think it will be. And we'll touch on gold in a moment or two, because there's a few things I want to say about that. But the issue is, at the moment, it's the US dollar that's still effectively the reserve currency, and everything the Fed has done through its trillions and trillions of dollars of intervention. The balance sheet's now close to 6 trillion. It went up by 1.5 trillion in about 3 weeks, I think, last time I looked. It's probably even bigger now. That's a massive amount of liquidity sloshing around the system. So that's what they're banking on. Okay, now Brendan said, would you pay down debt or take cash out of the bank for the short term if credit markets freeze up, even for a short term? Won't cash be king again? Yeah, well, I have to say that I think cash will be king. The question is, where do you keep it? That's an interesting question. But my general point is this, that debt, you can't walk away from it. Debt still needs to be repaid. So generally my thoughts are, it's good to have little or no debt in the current environment, despite the fact that interest rates are ultra low. And of course, if you do have big debts and you have some savings elsewhere, you've then got the question of how you crystallize that out in a case of a crisis, because if you actually, for example, were forced into bankruptcy, they would immediately net it off anyway, so you'd actually lose any benefit from holding deposits. My scenario has been for some time to not hold any debt at all, and to hold deposits in multiple organisations below the $250,000 cap of the insurance, which is not activated but might be activated by the government in a crisis. So that's what I've done. Cash is king. I actually think that's right. And I noticed that there were some people quoting one or two US commentators recently saying, you're dumb holding cash. That was before the crisis. It's funny how now suddenly people are starting to say, oh, maybe cash isn't so bad after all. Okay, now this is, I can't see from who that is, JMN and the rest of it. Does MMT bypass central bank printing for treasury printing, avoid interest rates on bond issuance? Yeah, well, of course, MMT has different ways of actually funding itself. It doesn't have to be from bond purchases. And in fact, classic MMT wouldn't be from bond purchases. It would be actually, as you say, those other mechanisms. And like I said earlier on, the thing about MMT is if you use that funding productively to create greater activity in the economy, greater economic momentum, it could work. But if you are effectively just printing money and then bailing out large corporates and central banks supporting banks, it's not really the classic MMT route, although many people are, I think, muddling the two at the moment. Somebody asked, should I buy shares in Genworth? Yeah, well, I'm not going to answer that directly. What I will say is that lenders, mortgage insurers, I think, will be the first cab on the rank in terms of problems, right? Because essentially, as property prices fall, many of those first-time buyers are going to be in difficulty. But I'd also highlight those that bought on the 95% government-backed scheme. Do you remember that? 95% just put 5% deposit in. Chances are they'll have already lost that 5% deposit, and the government may be up for the next 15%. Yeah. And of course, QBE has basically put a clamp on future transactions for a number of industry segments. And more generally, what I would tell you is that the lenders are less willing to lend for some particular industry groups previously. So if you are in the hospitality sector, for example, or in the construction sector, you may find it very difficult to get a mortgage. We're also hearing quite a lot of reports of some banks who'd made provisional loan offers, and they've now withdrawn them. So I think we're already into a credit freeze, frankly. Okay. Now, Steve's asked a really interesting question. What do you think the long-term political ramifications will be at the federal and state level to effectively deal with this? What will the major parties survive? Is the pandemic a trigger for a new global monetary system? Just a few questions there, Steve. Look, the political establishment are basically all buckling down and supporting the current system. Labour is, pretty much on the same page as the other side. They're both tarred with the same brush. They're both essentially saying you have to do what you have to do in a crisis. I suspect in a crisis, the incumbent tends to be better supported. And in fact, the popularity stakes of ScoMo has gone up quite a lot. I think that will continue until people see the real damage that's being done. The question is, will it then backfire? And that's the unknown quantity. Now, in past crises, we often see splinter parties and minor parties beginning to emerge, and even some political realignments, either to the left or to the right. My worry is we might start to see some pretty right-wing stuff going on. That would not be good. We might also see some realignment of politics around, if you like, a more green agenda, because, of course, we've still got climate change going on in the background, and that hasn't gone away. And, my own theory is that when you actually come to restart the economy, we should be trying to redesign the economy more around sustainability, more around building locally rather than very strong international supply chains. So there's a big political agenda. But remember this, politicians have been up for an alibi, an excuse to blame for 20 to 30 years of bad management of the economy. And they've got a perfect alibi. The health crisis did it. Nothing to do with us. It was the health crisis, and we're reacting. The truth is that, it certainly created a catalyst to something which was always going to happen at some point. But their mismanagement over 20, 30 years is what really is to the fore. There's the financialisation of society, the financialisation of financial services more broadly, the fact that we've given up on productive industry in Australia pretty much is all part of a much more important narrative. And I suspect there will be a political awareness of that. The question is, at what point will that come to the fore? And then the other part was, will it change the monetary system? Depends a little bit. If everybody suddenly turns around and says, central banks, you've created the problem, because they are part of the problem, they're not part of the solution, maybe. But at the moment, central banks are seen to be the people who've saved the financial system, and so they're basically the white knights riding in and saying, we'll just throw some more liquidity on the barbie and everything will be fine. So I'm not sure it will necessarily lead to something new. Okay, what else have we got? I think I've covered the unemployment. Whoops, I just jumped a few. Craig, I appreciate that contribution. Thank you. What else have we got? Do you think there will be a rolling cycle of lockdowns in the cold months and coming out of hibernation in the summer? Possibly. The issue is, I remember the mayor of New York using an analogy, saying, look, we'll turn the knob a bit and we'll see whether we can actually flatten the curve. If not, we'll turn the knob a bit more and we'll flatten the curve. If we turn it too much, we can turn it up again. I'm not sure it's going to work like that. That's the problem. I'm not sure that we can actually turn it on and off or back and forth. Now, you could argue that the right way to deal with this is to isolate the more vulnerable sections of the population and try and let more of the economy, if you like, come back. The question is that going to work? And as I said earlier on, only if you can make it work elsewhere as well because of the international connections. This is a really wicked problem. So I'm not sure whether we're going to see cycles of lockdown and not lockdown, possibly, but I'm not sure. Andrew says, could I do a show with Sanjit? Well, yeah, if he wants to. We have tried a couple of times through various channels, but so far, no joy. But I'd be very happy to do something with him if he was able to come up. Now, Peter's quoting the various, chemicals that have been quoted as potential solutions, or at least alleviation mechanisms. They haven't really been fully tested yet. They're being tested in various locations at the moment. It's too soon, I think, from my reading of what's going on, to be able to say that there is a solution. But who knows, maybe. Now, somebody's come up and said, well, hang on, vaccines, think about that. You want to inflict vaccines on everybody? Is it going to be compulsory? What about people who actually object on principle to being vaccinated? Yeah, all good questions. Like I said, wiki problem. The trouble is, if you don't deal with this particular health issue now, it's going to go on and on and on, right? And you've seen what the potential is for it to wreak havoc. So we have to try and get to grips with it one way or the other. And there are people who say, well, actually, look, it's just like flu, right? Actually, we're not detecting sufficient numbers in the population because we're not testing. And the chances are it's really just, like the flu. So it's not really a big issue at all. We're just seeing the tip of the iceberg. And so therefore the fertility rates are a lot higher. I'm not sure. I can't tell. We don't have enough data one way or the other. We need, I think, a statistical tests done. In other words, let's draw a ring around a particular area and get everybody to effectively be tested to understand what the real community penetration is and whether there's a lot of community transmission or not. Don't know. Too soon to say. Ian says, on the other end, when economies start up again, do you see a state-funded race to the bottom to get unemployment down and kickstart growth? Seems like a reasonable risk. Yeah, I think there will be a lot of, we haven't seen the end of stimulus. I know that for a fact. There will be a lot more being thrown at it. And, frankly, the degree of stimulus and the length of it will be determined by how long it takes. This is going to take a lot of money, and a lot of it's going to have to come from government. Obviously, that government money is ultimately taxpayer funded, right? Directly or indirectly. So that has a direct consequence on taxation policy. It has a direct consequence on what else you spend money on, what you don't spend money on. So at some point, we're going to have to throttle back and not spend as much in other areas. This is this is a really wicked problem. There will also be, I think, a redefinition of relationships between countries and trade routes and those sorts of things. Maybe we need to redevelop a strategic oil reserve here rather than just rely on the US to help us out because we don't have very many days of oil on the shore here. Duke Ninja says there will be forced vaccinations requirements for health sector workers. Yeah, possibly. Remember, the vaccine isn't there yet. They're testing it, they've started it, but it's a long process. And remember that quite often these normally take years to actually get from initial development through to deployment. So this is not simple. Greg says, what percentage do you think a banker and lender will want for an unoccupied house with secure employment? Yeah, it's very difficult. You can't give a generic one there, Greg, because it depends on all the other circumstances. They've still got responsible lending obligations. They still have got to look at that. Responsible lending obligations were sort of parked for commercial lending, but not for property lending. Now, Ben says, if stagflation happens, as you say it might, and they continue to pump currency into the system, do you see hyperinflation happening here? What I said earlier on. If all the countries around the world do the same thing, then the differential currency movements that will be required to create hyperinflation probably won't work. So I'm less convinced about hyperinflation than many people. I think it's more likely to be deflation rather than inflation. In fact, if you look at Japan, they've been doing this for a long, long time, and they do not have an inflation problem. That may be a model of what we're going to see. And yes, somebody else has asked, do you think they'll make the vaccine compulsory? I don't know. Very interesting question. What happens? We know that there will be some who will resist it because they are concerned about vaccinations generally. We know that there'll be some who will resist it on religious grounds. You need herd immunity, right? That means you need a certain proportion of the population to be able to be either with the antibodies because they've had the infection, it's moved on, or through vaccination. So tricky policy issue again. Somebody's asked about Steve Keen. I had Steve Keen on a few months ago. There's several shows in the DFA archive with Steve. I may reach for him again. We'll see. So where are you keeping your money in cash? Says Easy Video. In cash, gold or crypto? I'm in cash. I've been money in the bank. I still am of the view that the banking system is being supported and will be supported by central banks. We've seen it already. Everybody is worried about financial stability and central bank stability, and central banks are doing all they can. That, I think, gives me some confidence. If you'd asked me a month or 6 weeks ago, I was probably more concerned about bailing of deposits, for example. At the moment in Australia, I'm less concerned about that. So I'm keeping below the 250k in each brand, which of course is the government deposit guarantee. And so far, there hasn't been a massive run. There have been a few people, pulling a bit more cash out, and we know that banks have been limiting cash availability, but that's more to do with the fact there isn't a lot of cash floating around the system, because up until very recently, people were spending most of their money electronically rather than in cash, so that the supplies of notes were actually somewhat lower than previously. But at the moment, there doesn't seem to be a huge concern. So as I say, I'm in cash. I'm not in gold. Thing about gold is, I'll just cover gold now, you don't know what the value is, and you can't eat gold, right? So there are some people who believe that gold will go up dramatically, and there are a lot of people, commentators in the US, who believe that that is the future, and they'll go very high. There are other people like Harry Dent that says, yeah, you're assuming hyperinflation, and hyperinflation may be, but if there is deflation, then the chances are, because gold tends to track inflation, the value of gold could actually drop considerably. And so it depends a little bit on where you think hyperinflation or deflation, right? And because that has an impact on gold. And with regard to Bitcoin, I don't know how you value Bitcoin. In fact, I interviewed somebody today who's in the middle of Bitcoin. I'll put this post up in the next day or two. And, Bitcoin dropped quite a lot. It's gone up a little bit. There's a halving, of course, of Bitcoin within a month or so. And nobody quite knows what the value of Bitcoin is. So I still regard Bitcoin as a relatively speculative venture. And of course, there were, over the last month, as the volatility moved on, considerable movements in Bitcoin prices between exchanges. So people were actually, 1,000 off from price in one exchange to another exchange, so massive amounts of arbitrage opportunity, and that shows again the inefficiency of the Bitcoin systems and markets at the moment. So I think, you know, my view hasn't changed. I'm afraid that crypto is not something I want to be very much part of, although I do take crypto for the DFA if people want to make that contribution, but not many people do. All right, how are we doing? What about the yuan? So the yuan, I think, is very interesting. And yeah, the question, of course, is how is China recovering? So the latest data I've seen suggests that economic activity in China is now up to about 80% of what it was before the disaster. Not uniformly spread, but they are also seeing some breakouts, mostly I think from international importation of people coming back. They're not out of the woods yet. And so I think the yuan is going to stay okay. It's going to be reasonably strong. But, you know, what I said earlier on, is it likely to be replacing the US dollar? Don't think so. Okay, let's have a look. Likelihood of the Aussie dollar bouncing back. Well, it depends a little bit. This is from D. Depends a little bit on what happens to the US dollar, right? So basically the US dollar is moving up and down based on confidence and other factors and the fact that the Fed is supporting it. That explains why the movement between the Aussie dollar and the US dollar is happening. So it's less about what we do here, it's more about what they do over there. So the question becomes, what does the Fed continue to do? Does the Fed continue to drive a strong US dollar? Or do they want to actually throttle it back a little bit? The suggestions to me is they want to throttle it back a little bit simply because of the way that those flows work internationally. So we probably will see the Aussie dollar a little stronger now than it was previously. It's sort of 61 or thereabouts, I think. Craig, I appreciate that contribution. If I haven't acknowledged it already, thank you very much for that. Which bank do you deposit your cash? I'm not going to tell you, Robin. What I can say is I've steered away from the major four, steered away from the regionals. I've gone with some of the smaller organisations and also some of the foreign banks in Australia that are covered by the APRA deposit scheme here. You can actually get a list on the APRA website of all banks that are covered by that scheme, including the foreign branches of overseas banks. Okay. Cookie Boy says, peaked at 845 in the room. Yeah, indeed. It's pretty amazing. Bearing in mind that we actually didn't schedule this particularly far ahead. Perth Mint has no stock, says Thomas. Yeah, that's true. And there's also quite a big disconnect between the price of gold in the exchanges, in other words, paper gold, and physical gold. You have to pay a lot more premium for physical gold at the moment. People are arguing that may signal the breakdown of the two. Not sure about that, whether it will come back together, whether it won't. A lot of speculation there about the future of gold, and there are still many people saying gold is the way to go, for the reasons I've explained earlier on. Yeah, not sure. Now, Cookie says, noticed after the last RBA term deposits went up. Yeah, why is this the case? Because the banks want more deposits. So essentially, international funding is now a little less fun than it used to be for the banks. They used to be able to get international funding very cheaply. They're getting cheap funds from the Reserve Bank, but they also need to hold some of the funds from deposits as well. So they are basically competing for deposits, and they also want to try and keep people holding their funds in the banking system. And of course, if deposit rates go too low, then people will just pull the money out saying it's too much of a risk, I'll just hold it out of the banking system. So that's the reason why they're doing it. And it's a pretty consistent pattern, by the way, not just here, but in other countries too. Cookie says, I personally love this every 2-week concept. You mean the show's every 2 weeks? Oh, gosh, okay. Well, genuine question. If you think that this is useful to have these sorts of conversations more frequently, particularly now, I'm certainly happy to consider it. I have the gear to do it. I would normally do an update each day in any case, so it's not a huge difference to me. What I might do in a few moments is just go through some of the stock prices just so everybody is up to speed with what's going on before we finish today. But I'll just see what other questions there are. I haven't touched any of the questions I got beforehand. Just to say, those who asked me questions beforehand, if I don't get them on the live show today, I will make a separate show and I'll post them subsequent. I've just had lots of other questions come in. So down my question list, MMT, yeah, covered that. Deposits we covered. Now I'll just cover what Truth Seeker says. Are we depositors considered as lenders? Yeah, you're an unsecured lender to the banks, right? That's actually what it means. So basically, whatever you think about when you give money to the banks, read the small print, your terms and conditions, and you'll see that effectively they are giving you you are giving their banks an unsecured loan. That means that in a case of crisis, you would rank below secured creditors, but above other unsecured creditors. It also means that the terms and conditions that you hold are really important to understand, because they've changed them to basically say, if we are told to do X by a regulator, we'll do X. They used to have to give plenty of notice, no longer. So it's important to understand, and look, my honest view is, if you were really an unsecured creditor of the bank, they should be paying you 4, 5, 6%, not what they are paying. But the big myth, of course, is that you're giving money to the bank and they're holding it on your behalf. It's not quite that simple. Now, Gingerfish says, is there any way out of this without pain? Or are all the big wigs desperately trying all the buttons in case something works? Yeah. I have to say, it gives me the impression at the moment that they're, fingers in the dike time, right? So we'll fix that, we'll put they are making it up as they're going along. This is the biggest experiment ever, a financial sector experiment, and of course a social and human experiment as well with regard to the social isolation. We have never been so much guinea pigs as we are here. And my real point would be that those, in central banks and those in government don't have any idea whether it will work. They are literally making it up as they go along. And there are some risks to that. You'll often see policies that get tweaked and changed along the way. You'll often see things that don't work, and then they'll try other things. But that is the reality that we're in. The truth is, we are in uncharted territories at the moment. What I say to people is, it's almost not worth thinking a long way ahead, because you've got to get through the next day and the next day and the next day and the next day. But ultimately, we know we're going to end up with more debt. We know that we're going to end up with less businesses. We know we're going to end up with more households in financial difficulty and probably higher unemployment. And we know that the international trade processes that we have today will be rather different in the future. More than that, it's hard to say. Now, did I answer the how secure were deposits? My view is relatively secure at the moment. I would keep below the 250k, so spread it amongst multiple lenders, because there's less chance of losing some in a crisis. It also sort of spread the risks as well. But at the moment, because of the way that the banks are being supported by the central bank and by the government and everybody else, my own view is that the risks are probably lower than even a month ago. Cookie says, any new figures on retail commercial noticed today? News David Jones looks to be on life support. Yeah, well, the retail sector is absolutely under pressure, particularly for those who have not reconfigured their business and doing online. Some are doing reasonably well, particularly some with good online businesses, but many with physical real estate are struggling. Of course, many are trying to negotiate the rentals. The government announced the rental agreements for commercial tenancies today, or at least the principles. Still got to be worked through the states, but essentially they're trying to give some leeway either by rental deferment or rental holidays. It sounds to me as though there's still in the middle of horse trading between individual landlords and tenants. And like I keep saying, somebody who's a tenant and is paying rent, they're paying it to a landlord. That landlord is receiving that rent because they have got a mortgage they have to pay. So, the dollar just goes around. So wherever you break into the circuit is going to create pain. Very, very difficult. Okay, Brett says the next IOTP episode. Well, I'm recording hopefully tomorrow with John. We'll be doing an audio version because John is not able to get here. He can't travel. Of course, it's not regarded as a required or a needed piece of travel. So we've got to find a way of doing it remotely. So we'll probably do audio from John. Then the question is, do I do audio as well, or do I do John's audio plus charts? But we are looking at, there's a couple of things we're looking at. The first one will be to talk more about the superannuation sector. There's some big issues there. And we also want to come to some of the issues relating to the current health issues too. Okay. Michael, thank you very much. And let's look at your question. Do you think the politicians can now see what a debt-ridden market they have created and it's changing their thinking? No, they don't. They're in denial. They still don't see it as a problem. They are looking for an excuse. Like I said, the health issue gave them the excuse. But the fundamental issue of how much debt is too much debt has not actually touched the side yet in official circles. And that's true within the Reserve Bank, who argues that debt's not a problem because every time you write debt, you have an asset and they cancel each other out, so it's not a problem. Where, of course, we all know, if you're following the DFA channel, that essentially the more you create money, the more debt you actually produce, because effectively it's debt that produces the need to create more money, not the other way around. And that means that essentially you have more and more debt. And we've got to the point now where there's, 300 trillion, something like that, around the world of debt, more than we've ever had, going up dramatically even now. Is that sustainable? No, but politicians don't want to touch it because it will be hard, it will be difficult, it will change their fundamental, thought processes. And many of them are frankly captured by the Treasury and by the way the Reserve Bank thinks. Yes, please hit the like, people. If you like this show, please do show your appreciation. It would be very greatly appreciated. Now, this is from Pete. Is the cash in my mortgage offset account up for grabs in a bail-in? Now, nobody knows because there has been no case in Australia where effectively offset accounts have been bailed in. Generally, the write-off set-off, as it's called, between two accounts under one name would take precedence. So they probably would net it off first rather than actually hold you with a full mortgage and then nick your deposit. That's probably what happened, but it's not been tested, so nobody knows. There's no court case here. There's no clear view. So just be a little bit cautious about that. And I had somebody ask me, they basically got a lot of money from a house sale and were then saying, well, perhaps I should pay it into a friend's mortgage so that they can have a lower mortgage on the understanding I can get my money back when I want it. Just be a little bit careful about that because, of course, once that money's merged into that account, the mortgage balance drops and, the bank doesn't see it the way that you might see it. So you've got to be really careful with some of these things. I think cash offset in theory is nice, but in practice, I think there are some downsides as well. Somebody said, John Adams and I own a little Bitcoin. Yeah, I have a very small amount of Bitcoin simply because people have made contributions that way, but it's not my major asset, I have to tell you. Okay. This is from Cookie Boy. Gee, you're on tonight, Cookie. What are the chances of a bond market crash? Which bonds? Are you talking corporate bonds or are you talking government bonds? I think the corporate bonds could well crash. So we already know that, triple B bonds, double B minus bonds, like the oil sector in the US, because of the Saudi situation and the Russia situation, a lot of those are already in deep difficulty. There will be corporate failures and corporate failures of bonds. The question is, will there be, bonds issued by the US or Australia or the UK that effectively are defaulted? I think it's unlikely, simply because of the fact that they will just write more and more and more, and the central banks will just buy more and more and more. So the Reserve Bank has been buying up Australian government bonds, as I did made in my post yesterday, 2 to 3 billion each time they do it. So, that's a reasonable proportion. They're going to end up with something like 10 or 15% of all the Australian government bonds that were ever issued. So they're going to be on the other side of the balance sheet. So I don't think there's going to be government failure, but there could be corporate bond failure. Now, this is a very interesting question. Should we be worried about the potential massive withdrawals from superannuation funds we might have over the next couple of weeks following the government's announcements. Well, of course, there has been quite a lot of people worried by that, the 10K. A lot of superannuation funds have started to put roadblocks in the way. Super funds have been very bad generally at allowing access to the super funds when people want them. Now, whose money is it? It should be your money. You paid into that fund, but they tend to sort of want to look after it and as trustees, etc., etc. What I said before was that the withdrawals will crystallise losses. Some of those losses will actually flow back to holders of super funds that still remain. So in fact, people getting out may not take much of a hit, might take some of a hit, but not a lot, but those remaining might take more. The superannuation sector is going through a nightmare at the moment. And of course, they're being accused by the government of essentially not looking after their their individual savers, looking after their own interests first. That's probably true. Superannuation funds have had it fat and easy for way too long, and they've taken a significant risk they should never have taken. And in many cases, the returns that we're going to see over the next little while will be dramatically lower. Will they recover? Not sure. Will those who maintain money in superannuation feel the pain? Depends on how long you're in the superannuation sector. If you're in for 30 years and you've got another 25 years to go, probably be fine. But if you're trying to crystallise your superannuation balances in the next 2 or 3 years for retirement purposes, this could be a really big deal. And I'm already seeing in my survey some people having to essentially work for longer simply just to maintain their ability to be able to save. Okay, what else have we got? Rod said, open the borders. Yeah, well, I think we're going the other way around. I think we're going to see migration stalling. There's no migration at the moment. And we've actually had a Ponzi scheme in Australia for years where basically more people flow in and essentially just make it all happen. Maybe not this time. Okay. Right. So what I'm going to do now is just going to check back and see whether there are any other questions that I've missed. Okay. What will happen in 30 years when all the boomers die with regards to the stock market? Good question. Yeah. Will there still be a stock market? There probably will. We're going to see property flood back on the market because of the demographic time bomb basically degrading. We're going to see essentially the investment and all those savings that were there dissipate or go down the generations to an extent. This sort of baby bulge, which started earlier and gone on and is now into boomer land, is having a very significant impact on the economy, I think. Okay. Cookie Boy says, is emigration a real possibility? Yeah, possibly. I mean, I think we're going to see some significantly different things than relative to what we're seeing now. All right, now what I'm going to do is just going back to my other slides for a second. Just to say that if you want more information about DFA, you can go to the DFA blog. Lots of information on the blog. All of our posts are there. Subscribe and you can get all the alerts to your inbox every time we post, and you can also contact me directly via the blog at any time. We also do Patreon as well. This is quite important because, particularly now with the financial pressures on everybody, if you feel you can support me through Patreon, which is basically you can sign up for a number of different plans from $3 up. You can get access to additional content and early alerts on various things too. So that's a useful platform. Got quite a few people on there. You can also make a one-off donation via PayPal. People sometimes prefer to do that simply because they don't want to make a commitment. Well, in the current environment, fully understand. But any contribution that's made goes directly to supporting DFA. We don't make any money out of this. It's just to cover our costs, which are getting substantial simply because we're doing so much. We also do Bitcoin, as I said earlier on. There's a QR code for that. We've also got a DFA design which we've put together, which sort of tries to capture a little bit of the DFA spirit, and we've actually got now some merch. We've started doing that just recently. We'll probably do some changes to that and add some other things later, but there is now merch available on the channel. Again, just another way of perhaps helping the way to do it. Okay, just some quick on the top hits. Harry Dent, there are 2 posts. The big one, that's got more than 110,000 views a couple of weeks ago when Harry discussed, the big fall. He's come back. Yes, today I interviewed him, and there's another one there called "Are There Still More Falls Ahead?" And you can compare Harry 1 and Harry 2. There's some quite interesting differences. I continue to talk with Tarek Brooker, journalist. Some very interesting chats with Tarek on various issues. The 2-time bombs, I recognise that. We also now do the DFA dailies, so that's effectively a very net, simplistic mechanism to be able to just get some information out quickly each day on the main points. And also the Heart of the Matter with Tony Locantro. If you want a really deep and unsettling conversation, then listen to Tony's last post. It was pretty stunning in a way because, of course, some things have happened so quickly. And also with John Adams, we've got various posts on IOTP, including a discussion about MMT, and there'll be some more stuff coming there too. Now, the other thing I just wanted to do, as I said I would, was just quickly give you a quick update on the markets. You can see there, this is the ASX 200. So today, it was down a little bit to down 1.27% to 4,247. The financials index was also down. The real estate trusts was up 1.39% to 1,070. The volatility index was down 6.23%, so coming back but still pretty elevated. And the ASX 200 futures was actually down 1.01% to 54.5. Now, just in terms of looking over to the US, in terms of the forward views today, so the S&P 500 futures is looking pretty strong, up 3.31%. So, another good day. Had a good day yesterday, of course, with the Dow Jones up nearly 7%. And the NASDAQ futures, again, up 3.01%. So another up day. And that's all very much based on the fact that the truth is that most people are over in the US are thinking that the virus will be contained much quicker than previously expected. Vanessa, thank you so much. Appreciate that contribution. Really appreciate that. So there you go. That's just a little bit on the markets. I won't go through all the individual stocks. You can see there I have the screen up. But one question I would like you to tell me from a feedback perspective is: do you like to have all those details? Because each day now I've gone through a lot of stock information. Do you ever watch that, or is it just overkill? Be interesting to know. Now let's have a look. What else have we got? Quick look back over. Vanessa says, good night. I can't keep my eyes open. I understand that. It's the daylight change, that's part of the problem. Thank you for your time and thank you for your contribution. It's really appreciated. Cookie says you forgot to mention our interview from April 1st. Yeah, that was really funny, wasn't it? Cookie, we and I should have a real interview about these listings at some point. We should add it to the list. Okay, so we're at 9:29, and I think we're pretty much there. Plexus says DFA daily is good, but maybe not a market recap each day. Okay, very interesting. Thank you. Well, if other people think the same, then I won't bother with the market indices. I got quite a lot of feedback initially that people actually quite liked it, but I want to. Overkill, we can get that on paper. The facts and figures don't give us the so what. Fair enough. Okay, that's good. Somebody's asked Fat Cat about Sweden's approach to COVID. Look, I'm not going to go into that now. What I may do is part of my conversation with JA, we'll perhaps talk about what other people are doing, including Sweden. Interesting, did you notice that Singapore's got an uptick now? They were doing very well. It's less so now. Okay, well, I think, oh, very good. Brenda said, what's the future price of toilet paper? To my reply is supply and demand, mate. Supply and demand. That's what it's about. Okay. And Mark said twice a week for the recap. Fair enough. Okay. Well, that's good. I'll not include the prices each day. And we'll just focus on the information. What I try to do with the DFA dailies is to find you the most relevant and critical pieces of information that I think you need to know and which are not being reported in the mainstream. And that really is my main objective. Okay, so, yeah. I think the general consensus is I don't need to do the indices so frequently. Thank you very much. That's great news. Scott, thank you so much. Really appreciate it. DFA Daily has been great over the last few weeks. Thanks. Great. Well, I think I found a formula. And by the way, it's a lot easier for me to make because I don't do so much on the production side. I just basically cram all the information in and just do some basic transitions. So it's actually quite a lot easier to produce as well. So, there's somebody suggesting Mike Maloney. Yeah, I've got a whole bunch of people I want to get on the channel. A lot of people have made some great suggestions. Keep them coming. Always interested in some shows. It's just a matter of finding time and getting a few other things going on. If in fact you think that this is useful every couple of weeks, Cookie's advocating it, I'm going to consider that. I will do another one in a couple of weeks in any case. So the next one will be the normal show, which will be on the 2 weeks from today. So that'll be the 21st of April. And then we'll review whether we do another one 2 weeks after that. The Tuesdays are quite good because, of course, it's the same days that the Reserve Bank makes their statement. And then 2 weeks later, the day that the Reserve Bank releases the minutes of their meeting. So we have something to hang around. And Brendan, thank you very much. I really appreciate that too. So there you go. I think that is pretty much what I'm going to be able to cover today. BM says, I'd love to hear you interview a politician. We've interviewed a couple of politicians on the IOTP. I must tell you that politicians and property bulls tend to avoid interacting with me. I have no idea why, although I can perhaps guess. And somebody suggested we should invite Trump over to come and run the country. Well, there's a thought. Okay, and Dee's working from home. Always love watching DFA. Thank you so much. Great, thank you. So thank you very much for your time today. Obviously, I want to wish everybody a period of safety. Keep well, keep safe, keep isolated. Keep those distancing things going. It's all very important. And we'll be back with more news and updates so that we can actually continue to propagate the real narrative as to what's going on and give you a much more deep sense of everything that's there. So thank you very much for your time. Vita asked on the bail-in laws, there's no change. So the bail-in legislation that was introduced into Parliament to remove deposits has got basically sidelined because the Parliament's not there. And so we're still in that vagary. Same also true with the cash ban. That hasn't gone anywhere either, which is probably quite good. So thank you for your time today. Take care, sleep well, and we'll see you in 2 weeks, same time, same station. Martin North from Digital Finance Analytics, signing off.